Hello guys, you are welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. Welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. Welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. Welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. All right, so welcome back once again to our live session today. So if you just join us, do all to share right away so that we get started. So today, as we discussed earlier, we are going to look at practice exams question on remuneration and payroll accounting. I hope I can be heard loud and clear. Do all to share the video so that all So let me share my screen so we get started. Let's take note of that. So it goes like the following is an extract from HR records of Himaria and Amira Company. Payments and taxes are determined based on the schedules below. So we have the Sunday contribution, we have overtime rates, we have the weekend duty, and then we have monthly tax. And we are asked to use this information to answer from question 1 to 10. So that's what we are asked to do. So let's see how we take them in that case. I hope I can be heard loud and clear. If I can be heard, let me see in the comment section. Okay, so these are records from HR records on employees' word information concerning their payroll, payment, and then other expenditures that comes as a result of their income they generate at the end of the period. So this is a monthly tax schedule so that you can see here. Okay, monthly tax schedule you can see as well. So these are the table for these employees. So we have what? We have Mohammed Issa, we have Zolasi, we have Gabriel, and we have what? Atani, right? So first question goes like, what is this? Oh, come on. Okay. It goes like, what is Mohammed Issa's regular income or regular earning? What is Mohammed Issa's regular earning? So to determine the regular earning of an employee, regular earning, right, RE should be equal to the actual number of hours that the organization has set for employees to work. And in this case, you can clearly see from here that it says that overtime rate bullet 2 said overtime rate for all work above 40 hours attracts what 1.5 multiplying that is overtime. So all I'm trying to emphasize on here is that here the employee standard hours for the work to be done should be what 40 hours, and any hours that exceed 40 hours will go for what an overtime what bonus or overtime what income. So mean that the standard hours is what 40 hours. So all that I want you to do is to look at the table here. What is the total number of hours that Mohammed Isa actually work for the employees or work for the organization, sorry, and that was what 58. Here is what 58. So meaning that Mohammed Musa was able to work almost 18 hours extra above the standard hours of what 40 hours. Because when you subtract 40 from 58, you'll be left with what's 18. That becomes the extra, right? So let's take note of that. Okay, so in that particular case, we will say that Mohammed Issa's regular earnings should be equal to the standard hours set for the organization should be what 40 hours, okay? And then multiply by the rate for Mohammed Musa, for which we know is what 62. So that should be what 62. It's in cities, so 62 what Ghana cedis. So what are we getting? So when you compute this with the help of your calculator, you should be able to get what 2,400 and what 80. 2,400 and what 80. So that's what we're going to get for the regular income for Mohammed Isses as his regular income. So let's take note of that. And then question number 2, how much overtime tax does Mohammed Issa pay? So now you get to know that of his regular income to be 2,400. So what will be the overtime? The overtime condition here is that each employee, once you're able to work that is above what 40 hours, any extra hours goes for what 1.5. So the 1.5 becomes what the kind of how should I even put the motivating factor, right? That will increases your chance of earning what more what over time. Okay, so we realize that Mohammed actually worked for what 58 hours. Number of hours work was 58 hours, but the organization actual standard hours say it is what 40 hours. So any extra difference going to be accounted for by as an overtime, right? So here we can say that overtime for Mohammed Musa should be equal to overtime income. Okay, we are asked to calculate what overtime tax, but before we get the tax, we must calculate what the overtime income. So overtime income, right, should be equal to 58 minus what 40, being the actual number of hours set for the organization. Compare that to the number of hours that was worked by the employee, which is Mohammed Issa, right? And then multiply by the motivating factor, for which we know is what one and what half, 1.5 here, 1.5 here. So bring that also here. So 1.5. So that means what is what 1.5. 1.5 means the same thing as what 1.5. Okay, and then multiply by what was the hourly rate for Mohammed Isa? That was what 62. 62, you can see here. So here you multiply by what 62. Okay, so we are getting 18 multiplying 1.5 multiplying what 62. So with the help of your calculator, when you're able to compute this, you should be able to get an overtime income for Mohammed Isa to be equal to 1,674, right? But we were asked to find what overtime what tax and not overtime what income. So let's go through the condition that was given for the overtime tax, and it says that all overtime that you can see here, the last bullet here, goes for what 10% flat as what a tax. So for us to determine the tax for Mohammed Isa, then overtime tax overtime tax amount should be equal to 10% multiplying what the regular overtime income earned by what Mohammed Isa, and that was what 1,674. And what are we getting with my calculator? When I computed for that, I had a figure of what 167.40 as the overtime what tax that Mohammed ISA will pay on his overtime income at the end of the day. So let's take note of that. Question number 3. What is Kumozi, Zolazi? Their names are kind of, so spare me for that. Zolazi's overtime what income. So we are asking for Zolazi's overtime income. So the same way we computed for that of the Muhammad Issa's regular income as well, the overtime income, the same going to follow it, right? All that I want to do here is for us to know the overtime income for Zolazi. That should be the actual hour that was worked, or the number of hours that Zulazi work, compare that to the standard hour that was set by the organization, which is what, 40. Okay, so the actual hours for Zolasi was what, 60 hours. You can see here 60 hours. Okay, so we compare that to that of for the 40, which is the standard hours for the organization. So we will say that the overtime income, okay, for Zolasi should be equal to that of what? Remember, Zolasi worked for how many hours? Zolasi worked for 60 hours. That you can see here, 60 hours. So we'll compare the 60 hours together with the benchmark hours of what, 40 that was set by the organization, and then multiply by the motivating factor, for which we know is what, 1.5, which is what, 1.5, and then multiply by the regular income or the hourly rate for Zolasi, and that one was also what, 60. Please do want to share the link so that others will join us. In that case, 60. So we get what, 60 here. Okay, so what are we getting? So here we have 20, we have here to be what, 1.5, we have here to be 60. When you multiply this, you should be able to get an overtime income for Zolasi to be equal to 1,800. This is what I was getting at the end of the day. So you can cross check with your calculator and let's see if that is true. Okay, so that is for the overtime income for Zolasi. Question number 4. What is Zolasi's regular income tax? What is Zolasi regular income tax? And let's go back to check the condition for regular income tax. Before we can compute for the tax schedule that you see here, the tax column here, for any employee, that should be accounted for by taking into account the SNET contribution. Remember, it says SNET contribution is what? 5.5% from employees' basic what earning. So meaning that once you're able to get a SNET contribution for whosoever you're asked to calculate his income tax, you must get the SNET contribution. Once we get the amount, we subtract that amount from the regular income for that particular employee. Whatever is going to be left becomes the taxable earning. And based on that, we're going to calculate the tax. Okay, so here, who were we asked to calculate his regular income tax? That was what, Zolasi. So for us to get the regular income tax for Zolasi, we must get our taxable earning. And how do we get our taxable earning? And based on the condition of this question, said contribution is calculated on the basic salary, which is the same thing as what, the regular income for that particular employee. So let's take note of that. So in this particular case, we need to know the regular income for Zolasi. Okay, we need to know the regular income for what? Zolasi. So let's see. So we'll say that the regular income or the basic earning, so regular income for Zolasi should be equal to, so here is going to be the standard hours, right? Since I think Zolasi also work 60 hours as the actual number of hours, so that's going to exceed the benchmark hours set by the organization, is what, 40 hours. Okay, so we know that Zolasi's regular income, have we calculated that? No. So we straight away can calculate that as what, 40, okay, multiplying the hourly rate for Zolasi, which should be what, 60. Okay, so bring that 60 here too. So what are we getting? We are going to get what? Or let me bring it here. We are going to get what? 2,400. That's what I got in my case. Okay, so once we get the regular income or the basic earning for Zolasi, the next thing is for us to find our taxable earnings. And how do you find taxable earnings? You find taxable earnings based on this condition. Taxable earnings will be computed for by taking into account the difference between the basic earning for Zolasi and that of what, the net contribution. Okay, but to get a SNP contribution to, we said it is 5.5% on the basic earning. Okay, so once we get that, you subtract from the regular income and we get what? The taxable earning. There are times where the examiner can also ask you to calculate the SNP contribution on the gross earning. In that particular case, you must calculate this on that, and then you get to know your taxable earning by subtracting the single contribution from the gross earning so that you get your taxable earning. But where you are asked to calculate it on the basic earning, then for you to get your taxable earning, it is a single contribution taken from the basic earning so that you get your taxable earning. Okay, so let's take note of that. Okay, so if that is the case, then we also need to know that of what our SNET contribution. So our SNET contribution should also be equal to what? 5.5% multiplying what? The basic earning or the regular income for what? Zola's, for which we know is what? 2,400. So what are we getting? With my case, I had the SSF to be what? 132. Okay, so once you're able to get what? 132, then what will be the taxable earning then? Taxable earning. And that should be equal to the difference between the regular income, which is what? 2,400. 2,400. Compare that to that of what? The snake one, which is what? 132. And what are we getting? At the end of the day, you should be able to get a taxable earning of what? 2,268. So you're going to get what? 2,268. Okay, so once we're able to get our taxable earning, that is fine. So we're asked to calculate what the tax that Zolastic must pay on his regular income tax, must pay on his regular income, sorry. So that's why you have gotten as well the taxable earning, the taxable earning. Okay, so let's take note of that. So in this particular case, we're going to have a schedule for us to calculate what the regular income tax for Zolastic. So this is going to be, you have a column called taxable earning, but in this case, it is what? A taxable earning as what? A balance. And I will explain that. So I'll shorten it balance. And we have taxable earning as one. We also have what? Taxable earning as a balance. Okay. And we have what? Our rate. And then we have what? Our tax amount. I will explain all these items. Our tax amount. So this is what we're going to do. So the taxable balance is actually going to be any remaining balance after we computing for our taxable earning. And I will explain that. For example, you see now we have what? Our taxable earning, which is what? 2,260. So as it stands now, we have a balance of what? That we need to pay tax, or that Zolastic must pay tax on it, to what? 2,268. So this becomes the taxable what? Balance, taxable earning balance. Okay, so now let's go back to the schedule and then compute for that. Because here was giving us what? A monthly schedule. We just use that to compute for that. Okay, so the first condition here is that for the tax, 365 being the first schedule, attract what? 0%. Please here, stay with me carefully. It's very important so that you get it right. The first 365 Ghana cedis goes for 0%. So it's tax free. So this is what we're going to do. We will say that that's going to be at the column of for the taxable earning. So the taxable earning is going to be the amount going to apply the tax on, that you can see here, right? These are what I refer to as a taxable earnings. Okay. So in this particular case, we will have what? Our 365. And what is the rate? The rate here is what? So here, let me just indicate the percentage here. The rate here is what? 0. So 0% multiplying 365 same thing as what? 0. So here the tax amount is what? 0. So tax free, 0. Okay. So once you're able to compute the first schedule, for you to compute the next schedule, you must subtract the taxable earning that was given as what? A schedule here, okay, from the total taxable earning that the employees must supposed to pay tax on. So once you calculate what the rate on the taxable earning, you subtract from the total taxable earning so that we get to know the balance. That's why I refer that as what the taxable earning to bracket balance. So we subtract what the 365 from 2268. Okay, and whatever you're going to get becomes the balance going to use to apply for the next tax schedule. Hope that is clear. So when I subtract 365 from this, I had what 1903. That's 1900 and what 3. Okay, so the next tax schedule it goes forward. It goes forward 110, and which attracts a tax rate of what 5%. 110, which attracts a tax rate of 5%. So here we have what 110, and the rate is what 5%. I've already indicated the percentage here, so it affects everything here. Okay, so 5% applied on what 110. With my case, I had what 5 point what 5. I had 5.5. Okay, so once you're able to get the tax amount, that is fine. So the next tax schedule you're going to apply is to subtract 110, that's 110 from the balances, so that we get to know the balance from the total amount that is left, so that we can continue to uh, kind of pay the tax on the balance as the taxable earning, the total taxable, the general taxable earning in that case. So you must subtract 110 from what 1903. And with my case, I had what 1793, right? So what was the next tax schedule? In this particular case, it was what 560, which goes for what 10% what rate as tax. So here too, you bring in your 560, which go for 10%. Okay, 10%, right? So 10% application on 560, you should be able to get what 56. So once you get 56, that is fine. That is done. We are done for that column. And then for us to get the balance remaining, we subtract the 560 from this amount so that we get the balance. So when I subtracted that, I had what 1233. Okay, so you ask yourself, what is the next taxable balance that you must pay tax on? Based on this tax rate, there was what 3,000. So when you compare the 3,000 here to the taxable balance that is left, which is what 1,233, that should tell you that we can actually pay all 17 point what 5% on this amount, because our taxable earnings that we must pay as tax is less than what this amount, which is what 3,000 here, because we have the balance to be left with what 1,233. Okay, so since this balance is less than the 3,000 as per the schedule, then we are not going to pay that 17.5% on that 3,000, because this balance is left is less than what 3,000. And so therefore, since it's less than 3,000, you are going to apply the 17.5% that you see here, okay, as a rate on the remaining balance, which is what 1,233, as a balance that is less than the next taxable amount that you should afford, pay 17.5%. That is how we go by this kind of tax schedule. So let's get it right. So in this case, our taxable earning will then be equal to our taxable what balance. So that should be what 1,233, and that will go for a rate of what 17.5%. Okay, when you calculate that on it, you should be able to get what 215, okay, 0.775. Okay, so in this case, what are we left? What will be our balance? When you subtract taxable earning of this from this, you get a balance of 0. Okay, and 0 is less than the next balance, so we can't compute anything from 0. When you compute it, it's going to result to 0. So there's no need for you to take on the next activity or the next task schedule. Okay, so once you are done, then you sum up the totals. So what are we getting when you add 0 plus this plus this plus that? You should be able to get what? You should be able to get what? 277.28. Run it to the nearest what 2 decimal place. Should be able to get what 277.28. So this becomes the total regular income tax that Zolasi paid on his taxable earning of what where is it? 2,268. So let's take note of that. So this is how we calculate what the tax schedules in that particular case. So let's take note of that. Okay, question number 5. How much tax does Gabriel Eshon pay in total? So here too, we will compute the total regular income tax for Gabriel or Eshon, and then as well also compute what the overtime tax. So when we put the two together, we get what the total tax that Gabriel will pay, right? So this is what we're going to do. You must first of all calculate. Do you know the basic earning for Eshon? No. So you must go back and then do that. So Eshon to also work for what? 56 what? Hours. Eshon work for 56 what? Hours. 56 hours. And then the standard benchmark hours is what? 40 hours. So mean that Eshon work what? Extra hours, which will attract for overtime. Okay. So we need to calculate that for the regular income for Eshon. So what are we getting, or the basic earning for Eshon? What are we getting for that? You should be able to get what? 40, and then multiply by the rate for Eshon, which was what? The hourly rate of 70. 70 here. We can see that 70. Okay. So what are we getting? We are getting what? When you multiply, you should be able to get what? 2,800. So once you get 2,800, that is fine. The next thing you also need to calculate that of his what? His overtime what? Income. His overtime income. Okay. His overtime income. And his overtime income is going to be that of what? 56. Okay. Being the actual hours that Gabriel worked. Okay. Worked. Compare that to the standard hours of 40, multiplied by the motivating factor of what? 1.5 time and half, and then multiplied by the hourly rate of Gabriel, which was what? 70 in this particular case. So what are we getting in total? Here you should get 16 multiplying 1.5 multiplying what? 70. So what are we getting as overtime income? With my case, I had what? Overtime income to go what? 1,600 and what? 80. 1,680. Okay, so once we get that, that's fine. So here it is out of this going to compute our regular income tax and then the overtime tax as well. But when it comes to regular income tax, you know how it goes. You must subtract your SSF amount before you compute so that you get your taxable earning and use the same understanding you derive from that of the last one to compute for that, and that will be all. Okay, but we can straight away calculate the overtime tax for what is shown based on the overtime income. And what are we getting? So let me create a space here. So overtime tax for Sean should be equal to, we know that the overtime tax goes for what? 10% flat, right? As you can see, a 10% flat. So here, since we know his overtime income to be what? 1,680, we just have to multiply it by 10%. And whatever we should get becomes for the overtime what? Amount. So what are we getting? With my case, I had what? 168. I had 168 as the overtime tax for Ishon. But we are left with what? That of his regular income tax. Okay, that's what we are left with. So before we can get that as well too, we need also to get our taxable what? Earning. Our taxable earning. So let's compute for taxable. So taxable earning should be equal to, what are we going to do? We're going to compare that of what is regular or the basic earning, which was what? 2,800, and then multiply 5.5% on the basic rate based on this net contribution, which was 5.5% from employees' basic earning, which is the same thing as what the regular earning. Okay. So when you don't see basic earning, you see what? Regular earning. They are the same thing actually. So you multiply that by the regular earning, for which you know is what? 2,800. So whatever you get, you subtract from the regular earning, and you get your taxable earning. So in that case, you should be able to get, so here should be 2,800, and here I had 154. Somebody can compute that, and let's see if that is true. Let's see. So 5.5% is 0.05. 55 multiplying what 2,800. So I had what 154. I think that is right. Okay. So once you're able to get that, when you take the difference, you should be able to get what a taxable earning of what? Taxable earning of what? 2,600 and what? 46. So now you're able to get the taxable earning of 2,400 or 2,646. So it is out of you going to calculate what our regular income tax for Asian. Okay. So let me create a space. So let me erase this. So let me erase this so that we can create a space for this calculation. Or better still, let me do this if it is possible. I think it will be possible. Let me bring it up some more here. Okay. So we follow the same schedules that we computed for Zolas, the same thing. So we have a column called the tax earning balance. Okay. Then we have a column for our taxable earning. And we have a column for the rate. And we have a column for the tax amount. The tax amount. So we have these various columns. Okay. So the tax earning or taxable earning balance in this particular case is what 2,646. So we have what 2,646. So that is the first thing you're going to do. What is looking at the schedules? Our first schedule is what 365. So now we know from that was the last week we can so that we pick the figures from there. So we have what 365. What is the rate here? The rate is what 0%. 0%. Okay, and that will go for a tax amount of what 0. So meaning that at 365 as a taxable and you pay 0 rate or pay 0% as rate on it. So it's tax free, actually tax free. So once you're able to get that, you subtract the taxable earning from the taxable earning balance, right? So we subtract what 365 from this. So that's what we're going to do to fill other requirements in that case. So what are we getting? When I subtract, I had what 2,281. Okay. So after that, I'll move on to the next schedule for which I know is what 110. Okay. And that goes for what a rate of what 5%. So 5% on 110 should fetch you what 5.5. So actually, if you actually get this principle right, you can for some of them you can even copy these what values. But just that the only thing that will change is going to be the taxable earning balance. Because then they're going to subtract the taxable earning from the schedule from the balance so that you get to know the now balance that is existing. Okay, so here we'll subtract, and with my case, I had what I had 2,171. I had 2,171. So 2,171. So the next schedule is what? Tax balance is what? 560, and that goes for what? 10%. Okay, so that should fetch you what? 56. So once you get that, you subtract from the balance. Okay, and what are we getting? In the bank case, I had what? 1,611. Okay, I had 1,611. And you ask yourself, this 1,611, what is the next tax earning that we need to pay? That is what? I think 17.5. Remember, the taxable earning for this particular case is what? 3,000. But 3,000 is greater than our balance left here, which is what? 1,600 and what? 11. Okay. So since it's greater than that, we won't be able to pay 17.5% on that 3,000 since our remaining tax balance is what? Less than that. And once it's less than that, you must apply that rate on the amount that is left, which is less than the taxable earnings that was given in the question or in the schedule. So here is going to be, so here our taxable balance going to be equal to our our taxable earning, and that should be what 1,611, and the rate go for 17.5%. And what are you supposed to get? With my case, I had what 281, 281 0.925. Okay, so once you're able to get that, you are done. The next schedule here, only subtract it from this, you are left with 0. So everything equal to 0. So we are done. So then you find the total. What are you going to get for this? So with my case, I had a total of what? 343.43 in 2 decimal place, 0.43. I had 343.43. You can also check for me to see if that is true with the calculation, with the totals. So once you're able to get the regular income tax for Ishon, therefore, we'll say that the total tax that Ishon will pay, the total tax should be equal to the overtime tax, okay, plus the regular income tax. And we had the overtime tax to board 168 here. So here we have to board 168 plus the regular income tax to board 343.43. So we have 343.43. And what are we getting? With my case, I had a total of what? Total of what? 511.43. Please do what to compute that to see if that is correct so that we all find ourselves at a safe word place. So this is what I was getting as a total tax that Gabriel will pay in that particular case. So let's take note of that. Then question number 6. It goes like, what is attorney's net income? So by net income, we define net income or net earning to be equal to our total gross earning minus all deduction. Okay, so once you get a gross earning, you subtract all deductions, right? Or subtract all expenses so that you get the net income or the net earning. Let's take note of that. So in doing that, then what are we going to do? We must find the gross earning for what? That of what? Attorney. From there, we can also know our deduction. Is that okay? So let's see how we get that. So here, this is what we're going to do. We'll go back to the table. Realize that attorney hourly rate is 100 and he was able to work for what? 50 hours. So mean that attorney will actually have an extra overtime hours of what? 10 hours. Okay. All right. So if that is true, then we need to compete for her. I think this is going to be a she. We need to compete for her regular income and that of what is overtime income so that we get a total gross earning in that particular case. So that's going to be, since we know that you're able to exceed the standard hours, that's going to be 40 multiplying what is hourly rate of what? 100, right? And that's going to fetch us what? 4,000. So we'll get what here to be 40 multiplying what? 100 as the hourly rate, okay? Plus, and we come back to that of his what? His overtime. So his overtime is going to be the difference between the number of hours work compared that to the standard hours set by the organization. And that's going to be what? 50 compare that to 40, multiply all by what? 1.5 being the motivating factor, and then multiply by what is hourly rate of what? 100 Ghana cedis. So here we are computing for his gross earning. And I think that's going to be all for his gross earning. So in this particular case, we are going to get here to be what? 4,000. Okay. And with my case, I also had the overtime income to be equal to what? 1,500. You can compute that and let's see if that's true. Okay, so this is going to be his total gross earning. So what are some of the deductions we're going to take into account? The deduction part. So the deduction part is going to be that of his XSF, right? And that of the tax that is going to pay, and as well or if there's, so in this case, this is what we're going to do. We are going to calculate his SSF as first part of the deduction in that particular case. So here we know that SSF go for what? 5.5%, and her regular income is what? 4,000. So what I want to do is apply what? 5.5% on 4,000. Whatever you're going to get becomes what? The SSF contribution, and then you also take that into consideration. So here we have what? Minus. So we start with the SSF, so which it should be equal to what? 5.5, for which we know is what? 0.055, multiplying what? 4,000 on its regular what? On its regular income, for which you know is what? 4,000. Okay, all right. So with my case, I had what? 220 on the calculator. So 220 becomes what is SSF. Plus, we also come back to think of its tax. That one, you need to follow the schedule to compute that. So because you have gotten understanding about how to compute for the tax, I will speed up a bit with the attorney's own. But do you also have any other expenses for attorney for which you know is true? That is what attorney other expenses goes for 250 here. Hope we can see that, right? So we also need to subtract that. We also need to subtract that. So let's go back and then factor that one in. So that is also what? 250. So what we are left with is attorney's what? Tax. Okay. So that one too, we create a schedule as we have been doing as usual. So we have what? The tax balance, the taxable earning balance. So balance. Okay, we have what? The taxable earning from the schedule. We also have the rate. Okay. And lastly, we have the tax amount. The tax amount. Okay, so how do we get the taxable earning, the total taxable earning from attorney's what regular income? In doing that, you must subtract what our SSF, right, from what the 4,000, so that we get the taxable earning. And when you subtract 4,000, let's see what you're going to get. So 4,000 minus what? 220. With my case, I had what? 3,700 and what? 80. 3,700 and what? 80. So that becomes the taxable earning for what? Attorney. So we have what? 3,780. Okay. So that becomes the first activity going to undertake on when it comes to taxable earning. So our first taxable earning goes for what? 365, and that goes for a rate of 0, and here is going to be 0. After that, we'll come back and then subtract this from the general taxable earning, for which in my case I had 3,400 and what? 15. Okay, so the next is what? 110. That goes for what? 5%. And I have it to 5.5. After that, you come and subtract 110 from what? 3,400 and what? 15. And in my case, I had what? 3,000. I had 3,300 and what? 5. And the next goes for what? 560, which goes for a rate of 10%. And here you should be able to get 56. Okay, and after that, you come back, you don't forget to come back and subtract what? The taxable earning from what? The general balance in this particular case. And with my case, I had what? 2,700 and what? 45. So when we get here, the next is going to be what? 3,000, for which we know that goes for what? 17.75. But 3,000 is greater than that of the balance that we have here. So therefore, we will say that it should be what? 2,745, as the taxable earning goes for 17.5%. Okay. And then what are we going to get with my case? I had what? 480.375. So when you add all, that's all. When you add all, you should be able to get what? 541.88. 541.88. So that becomes the total tax for that of attorney. So you also need to bring that one to factor it in this equation. So we have 541.88. So 541.88. All right. So what are we getting? In this particular case, when you add and subtract, with my case, I had the net income that attorney must pay to be equal to, so I had that to be equal to 4,338, 338.12, 4,338.12. Okay, so once you're able to get it, that's fine. So that becomes what? The net income that attorney will take. So by net income means that is amount you're going to take home. We call the take home pay. The take home pay. So let's take note of that. Okay, so I can erase this so that I can have space for the next question. So question number 7. What is attorney's Akumbile's SNET contribution, and we had that to be what? 2210. We can see from here the SNET contribution that we calculated on what? 5.5 on this. We had 220. So that we can say that here is what? SNET contribution patani to be equal to what? Since it is a theory that you must calculate, right? By bringing in that. So you're going to get what? 4,000. Do you know the answer already? Okay. Multiplying what? 5.5%. And you should be able to get what? 220 as a SNET contribution. All right. So that is that. Then question number 8. What is Gabriel Eshon's take-home pay? Gabriel Eshon take-home pay. So how also that's going to be? And I know we know that of the taxable, the total tax for Gabriel Eshon. I think one of the questions we asked the computer for that. Yeah. The total, how much tax does Gabriel Eshon pay in total? So we already have that. So that becomes the first part of the expenses, right? We know the total that in home to go enjoy with your family. So it's also known as what the net worth earning or the net income. Okay, it's the same. So net earning, net income, or take home what pay. So that should be what your gross earning minus what or deduction. Okay, so we compute the gross earning for what that of what Gabriel, that of Gabriel. So we know from question 5, that we can compute the gross earning for Gabriel, for which in this case, question 5. Let's go back to question 5. We realize that we're having the regular income for Gabriel to what? 2,800, and its overtime income of what? 1,680. All right, so we can add it to that becomes the gross earning for what? Gabriel. All right, so we'll have what? We'll have 2,800 plus that of what is overtime income to what 1,680 as we computed. Okay, so that becomes the total gross earning, and then we make all deduction. All right, so once we know the that of the 2,800 being the regular income or the basic earning, we can also calculate that of the tax. And I think we also calculate the tax even from question 5, where we wanted the taxable earning. Yeah, this one we can see. So mean that the overtime, I say overtime, the net contribution being the first part of the deduction is what 154. All right. So bring that here, 154. Okay, plus the total tax that Gabriel paid, which was what 511.43. So we also bring that also here as part of the equation, 511.43 plus. Is there any other expenses that Gabriel incur from the table? Let's see from the table. So from the table, we can clearly see Gabriel is number 3. We can see other expense as what 450 for Gabriel, right? The 450 here. So we can see that here. Okay, so also factor that into the equation. So what are we getting? So that's going to be 450. Okay, so at the end of the day, when you compute with that, subtract, add, and subtract, you should be able to get the net earning or the net income or the take home pay to be equal to 3,364.57 into the decimal place, 0.57, 0.57, 0.57. So let's take note of that. Then question number 9. What is, so you can clearly see that the questions are related. So once you solve one question, that will help you to deal with another. So once you solve it correctly, you should be able to deal with another so that you're good to go. Question number 9. What is Zola's total deduction? What is Zola's total deduction? So that's going to be, so the deduction for Zola's is going to be the SNET contribution plus the total tax here. If there was any other expenses, let's see if there was any other expense. Zolasi, okay, for Zolasi, there wasn't any other expenses was dash. So that's going to be the SNET contribution and that of what the total tax that you pay in that particular case. So what was Zolasi's what? Zolasi's that of his SNET contribution from So let's see. So you can get the net contribution for Zolasi as being part of what the expenses that we subtract deduction to what 132. What we can see from here, 5.5 multiplying the regular income of 2,400. So that becomes the first part of the expense, which is what 132. So we'll bring that here. So that should be 132 as a net. We won't calculate because for your calculator, we make reference to that question and then that will be all. Okay. But for a theory purpose, you must calculate everything so that you earn all the mark. But because I'm making a presentation and I've already worked for that, that's why I'm not working it again here. Okay. So after that, you also come back to the total tax that Solasi also paid. So that one is going to be the total tax, which is going to comprises of the regular income tax plus the overtime income tax. Okay, the regular income tax plus the overtime income tax. So let's see from that end to what was Zolasi's overtime income? The overtime income for Zolasi was what? 1,800, right? So based on that, we can calculate what is overtime tax, for which we know it is what? All overtime income goes for what? 10% flat. Okay, so we'll say that 1,800 from Zolasi's overtime income, which is here, okay, and then multiply by what? 10%, we go for 0.1, and we get what? 180. So that becomes what? That of his overtime tax as the expense. So you bring that one in there, and then you go for his regular income tax. What was his regular income tax? I think you can make that reference from question 4. So regular income tax for Zolasi can be from here. You can derive it from here, which is what? 277 point what? 78. So we also factor that one also here as part, as part of the total expenses. So we have what? 277.78. And that's going to be all the deduction for Solasi, since Solasi was having a dash for other expenses. So when you add all these three, you should be able to get what? A deduction of what? 589.28. That's what I got in my case. So you can also compare and let's see if that is true in that line. Okay, so if that is okay, then we move on to the last question and we'll see if we can take some questions in there and see how far we can go. Question number 10. How much money does the employer have to pay in total to these workers as regular income for the month in question? So here they're asking us to compute for the regular income for these employees, the 4 employees, for which you know it is what? The standard hours multiplying what? The hourly rate for these what employees. And remember, you have already computed for that already. And we can clearly determine all of them. So we want to know the total regular income that the employer will pay these what? Employees. That this employer will pay these what? Employees. Okay, so this is what we're going to do. We have already computed for the regular income for Mohammed Isa, and that is what? 2,480. So I'll bring in my calculator. Okay, so we'll just be adding them. So 2,480 as a regular income for what? Mohammed Isa, and we'll go for the next is what? Zolasi. Let's see if you also have the regular income for Zolasi. I think you can also get that from question number 4 here. Regular income as well, 2,400. So we also have plus 2,400, bringing that in here. Then we also go for Gabriel. Gabriel also regular income goes for what? 2,800. So plus 2,800. Okay. Then lastly, we go for the next person on the list is what? Or the last, that's Atani. So Atani, you can make reference to question number 6 also. Yeah, I think so. So the regular income for Atani was what? 4,000, for which it was 40 multiplying 100. So 4,000. So plus what? 4,000. And when you add all, you should be able to get what? 11,600 and what? 80. So that becomes the total regular amount that the employer will pay what? These 4 employees. So the total regular income, total regular income that will be paid by this employer is going to be 2,480 for the first employee. Second goes for 2,400. The third go for what? Third go for 2,800, and lastly 4,000. Okay, and you should be able to get towards 11,600 and what? 80. 11,680. Let's take note of that. Okay, I see some question coming in here. Let's see if we can pick them and then see how far we can explain them in that line. So, okay, Mary said, okay, yes, I can hear you. Like, okay, that's fine. Thank you for that. Then Golden Spot, okay. Golden Spot is saying that, please, I want you to explain LIFO and FIFO method for me. Okay, I will do that, but let attend to those who are bringing question on what we are discussing. After that, I'll come back to your question. So please just stay online so that I'll come back and explain your question once more. Since a different dimension from what we are doing for now. Okay, Judith Aful is saying that net sale is different from take home. Net sale is equal to take home minus other deduction, and take home is equal to total income. We use net sale when we are into what? Selling, right? When we are into trading, selling of goods or even a service. That's where we use the word net sale. But we use the word take home where we are making payment toward employees. We use take home in remuneration when it comes to what? HR related issue, human resource pay. That's where we use the take home or the net pay or the net earning. But we use the net sale where we are toward trading of goods or what? A service. So let's take note of the difference. So net sale will always be into taking into account the total sale that you made for the period, taking all returns, and if you have quota for it, you take all the quotas, and you, net sale should be simple. Okay, so let me give you this simple equation. It should be the total sale that you get for the period, taking all returns, right? Taking all returns. But if you have to calculate the commission for that's where you bring in the quota issue. But general net sales what? Total sales minus all what? Returns. So let's take note of that. We're saying net income. You mean net income? Okay. So net income or take home, they are the same thing. Okay. So take home means that we have all the total income or the total gross earning, subtract all expenses, and all expenses will include what? Your SNET, taxes, other expenses. All other expenses that you can think of, you subtract all from the gross earning, you get your net earning or the take home pay. Okay, so let's take note of that. That's how. So take home pay is not different from net income. They are the same thing. We use them simultaneous or they are kind of a synonym. So we use them interchangeably. That line. So whether it's a net income, take home pay, net earning, they are the same thing actually. So when you see them, all that you need to know is that is your gross earning, add all incomes for the period, taking all expenses in that line. So let's take note of that. Then Eura Equia Adu is saying that, please, does it mean that whatever you are supposed to find, whenever, I think you are trying to say whenever you are supposed to find the taxable earning, you deduct SNET from it before? Yes, you must deduct the SNET contribution, and that will also be dependent on the condition given the question. At times, you'll be asked to calculate SNET on the gross earning, right? So in that line, once you calculate that, once you get the SNET amount from the gross earn, you subtract that same amount from the gross earn so that you get your taxable earn. At times, you'll be asked to calculate your SNET from that of the basic earners, in this case that we're discussing. So once you get the amount, which is 5.5%, then once you get the amount on application of the basic earning or the regular income, you then subtract that same amount from the regular earning or basic earning for that particular, so that you get the taxable earning in that case. So always it depends on how the SNET it should be calculated, or how the SNET should be applied, on which value should the SNET be applied, whether it's applied on the basic earning or the gross earning. So if that is so, the question will specify so that you know how to calculate your taxable earning in that case. And at times, a situation where we are calculating our SNET contribution on basic earning arises where there are other incomes that is what non-taxable, right? So we have certain situation like that, a situation where you are asked to calculate what your second contribution on basic earning will come as a result of some other income for which is what non-taxable. So if it is non-taxable, then mean that you can't calculate tax on that income. And so therefore, the only way you can calculate your SNET contribution is you go into that of what your basic earning, so that whatever you get, you subtract that from the regular income so that you can get your taxable earning, so that it won't affect that of what the non-taxable incomes. That's the question says non-taxable. But a situation where you're asked to calculate what your net contribution on gross earning, meaning that all the incomes will attract tax, and as such, you subtract whatever you get from the gross earning, and you get your taxable earning in that case. So let's take note of that. And as well, to always the tax schedule to calculate the tax will always be given so that you know how to go by that. And I hope that is clear. All right. Okay, I think that was that. Okay. Okay. That's fine. Okay. So let me come back to Golden Spot. It's saying that, please, I want you to explain the LIFO and then the FIFO method. The LIFO and the FIFO method, as you are saying, LIFO means last in, first out. Last in, first out. And then FIFO means first in, first. So meaning that, for example, let's say if we have, let's say, items like, let's say, beginning inventory, which goes for, let's say, 60. So these are the units, and these are what the price. Let's say here goes for 5, and then let's say February we're having what, let's say 70, it go for 3, and let's say April we have, let's say 50, it goes for, let's say 4. Okay, so we are asked to, based on this information, calculate, let's say, our ending inventory, and let's assume that our ending inventory in particular case was, let's say, 30. This is our ending inventory in unit, and we are asked to use what last in, first out to value this what 30 units. Value this 30 units. How are you going to go by that? That's also very simple. So meaning that last in, first out means that whatever came in as what the latest inventory should be the one that should go outward first. So here you ask yourself, we have beginning February and then April. Which of them is the latest inventory? By latest, which of them is what new in the system? Let me use that word to actually to make it more better for you to understand. Which of these inventory is new in stock? Is new in stock, and that is from where April, right? So meaning that April's inventory must go outward first, meaning last in, first out. It came in the last, but is rather the one that is going outward first because of the principle. So meaning that we have April's on to go 50 multiplying 4, and we are getting what 200. Then that will be out. Since we have what 30 that was left, I don't know if should we get 30 as a balance so that I don't they use that whatever value for which you use that one to value. So 50 will be out, and that is all. And then 70 will also be out. So we have 70 multiplying 3, and we are getting what 2110. That is also out. Remember, our ending inventory in unit was 30. So meaning that's going to come from where? The beginning inventory. So meaning that the 60 unit that you see here, it is only 30 units of the 60 that will go out from the beginning of inventory, so that whatever is going to left in the 30 will be the value of the ending inventory of the 30. I hope we get that. So here, the only or the number of units that will go out from the beginning inventory is going to be 30. Okay, so we have the 30 here, which go for 5, and that should fetch us what 150, and we left with what 30. So that balance is multiplied by 5 and get so therefore our ending inventory in terms of value, using the last in first, that should be what 30 multiplying what 5, and we are getting what 150. This is the principle of what last in the first out. Let's assume that our ending inventory was, let's say, 40. That should primarily tell you that the ending inventory of 40, only just 20 units of the beginning that will go out, so that 40 that will be left, will multiply by 5, and we get what the ending inventory or the value for this what closing inventory or the ending inventory that you should be able to know. And I hope you have gotten that. All right. So that is what you need to know. And at times the examiner can ask you a question that how many units of what let's say how many units of let's say how should I even put it? How many units of let's say ending inventory actually will be found in let's say beginning inventory? How many units of ending inventory will be found in the beginning inventory? That is the same as the 40. Okay, that is the same as the 40. You can also even ask that how many, I mean, what is the value of what, or how much in terms of value of the ending inventory is coming from, let's say, February. Do you have any ending inventory coming from the February? That is what a big no. So that is what zero. These are the ways the examiner can ask the question. So that is a LIFO method. If you are to use the same information to calculate for FIFO method, that's first in, first out. The principle says that, okay, whatever inventory that came as what the oldest should be the one that should go out what first. Oldest means the inventory that has been in stock for what, a number of what periods. That should be the one that should go out what first. So first in, first out. Okay, so out of this information that you see here, which of these inventory came out what first? That is what the beginning inventory, right? That is has been the that has been in the stock for a number of what periods or a number of times. So that should go out what first. And since we have so here we are using the same 30. Since we have ending inventory to be 30, then so let me capture that 30 here. First in first out means that the 60 will go out first. So we have 60 going out, right, with its value multiplying. Okay, and then 70 with the 3 also go out because April's own is 50. So meaning that from April we can only issue what just 20 from April with a value of 4, so that it goes. So meaning that whatever is left is going to be 30, and that's why we're going to multiply by 4 so that we get the ending inventory for what the period using what first in first out. And I hope you get the principle. So that is the principle behind first in and last in first out. First in first out, last in first out. Golden spot, I don't know whether I've gotten my explanation. That is the idea behind the first in, first out, and the last in, first out. Any other question, please? Any other question? Any other question? Today might be the last section online meetings like this. So if you have any question, you can drop it in there. I mean, the live session like this, but videos will be posted for other courses. So if you have any question, please ask. Okay, in essence of that, then thank you so much. Thank you so much for joining us today on this channel. I'm grateful for always having you here to join us on this channel. So I'll see you in the next session, and all the best to all your future examination you may be writing concerning business maths. And I will see you in the next session. Bye bye.
Welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting.